Hello traders, you're welcome to this video and you're welcome back to the channel. So in today's video we are going to be looking at one of the most commonly used techniques in spotting trends and potential trade signals. Now the moving averages are one of the most commonly used indicators among traders, and specifically the crossover strategy is one of the most popular strategies that is related to the moving averages. And in this video we are going to be looking at the double EMA crossover strategy. So if you are ready to sharpen your skills and learn how to spot key market moments, then you might want to stick around as we analyze this in this video. All right, let's get into it. For those who might not be familiar, for those who might not be familiar with the exponential moving average, although it is a very common indicator. So I believe that a lot of traders will be familiar with the moving average. However, eventually you are not conversant with it. The moving average is an indicator that averages the price of an asset over a specific period. It finds the average of an asset, the price average of an asset over a specific period. For example, in this particular settings, we have 20 period, and peradventure we are on the daily time frame. It means that it finds the average price of the asset, which is gold in this case, XAUUSD, over 20 days, because the period is 20. So it means it finds the average price of gold over 20 days. If I change this to 50, it means it finds the average price over 50 days. Now, this place represents what parameter you want to use in finding the average price. If I select this to apply to close, it means it is the close price of each candle that will be used to find the average. So if we have the close price of this to be, as we can see, if you look down here, you will see the close price. The close price is about 2740.77. This is about 2747.43. So like that, the moving average calculates the close prices for 20 days if it is period 20, or for 50 days if it is for period 50, and it finds the average. Then as more candlestick forms, the moving average updates the calculation as more candlestick forms. Okay, so if you are to select that the average should apply to open, then it will use the open prices to find the average. So in case of if you are not conversant with how the moving average works, I just briefly described how it works right now. Then we also have a couple of methods for the moving average. We have the simple moving average, the exponential, the smooth, and the linear weighted. But in this video, we are going to be focusing on the exponential. Okay, the exponential moving average gives weight to recent price movements. Okay, it gives weight to recent price movements. So we're going to be using it for our double crossover strategy. That is the double EMA crossover strategy. Okay, so I hope I've been able to give a brief introduction into what we want to discuss in this video. Okay, so now the double EMA crossover strategy uses two EMAs, a short-term EMA like the 9-day EMA. So we're going to be changing this to the 9 period, and we're going to be changing this to close. We're going to be using close for our moving average, right? And then we're going to be adding the second moving average for this strategy, because this strategy uses two moving averages. So the second moving average we're going to be adding is the 20 period. I'm just going to change the color so that it will be easier to identify. Okay, now how does this strategy works? The 9-day EMA is the short-term EMA, while the 20-day EMA is the medium term EMA. So we have the 9 EMA as our short term and the 20 EMA as our long term. Okay, so when the faster EMA which in this case is the 9 EMA, it's represented by this red color. I gave it this orange red color for the 9 EMA. So how the strategy works is when the faster EMA crosses above the slower EMA, it's often a bullish signal, as we can see in this case. And when the 9 EMA drops below the 20 EMA, it's often considered as a bearish signal, okay, as we can see in this case. Okay, so here's what it looks like on the chart. When the bearish crossover happens, there's a tendency that the price of the asset is going to go down. Okay, and we can see that exactly happened after the bearish crossover. Okay, then in the case of a bullish crossover, when we have a bullish crossover, there's a tendency that the price of the asset is going to go up, as we can see here. Okay, now let's look at a couple of examples. Okay, in this case, we can see that we had a sell signal here. As the 9 EMA crossed below the 20 EMA, it gave us a sell signal. So we would have considered entering a sell trade right after the crossover happened. And then a good place to set stop loss would have been right above the previous swing high. Okay, this high would have been our reference point for setting our stop loss. So our stop loss would have been set somewhere out above here. Okay, now as for the case of take profits, different traders usually have different parameters that they use for setting their take profit. And one of the common parameters used is, or one of the common criteria used is when the price gets to a support level or a resistance level. Okay, so in the case of a sell, when the price gets to the nearest support level, because a support level is a zone where price tends to reverse back upwards. So that is the reason why traders usually use it to exit their sell trade in case of if a reversal happens. Like we can see that a reversal happened here, although this was a pullback because the sell trend continued. Okay, as we can see, the sell trend actually continued, right? This was a sell reversal that just began. It's a bearish reversal because you can see that the previous trend was actually a buy trend, right? But then we had a bearish reversal commencing right after this point. So this was just a pullback because a bearish trend actually commenced. Okay, but that's by the way. Once we notice that price has gotten to a support level, if you are a short-term trader or even a medium-term trader, you might just consider exiting your sell trade because we could have a significant pullback like we had here. Imagine the pullback got back almost to our entry point. In fact, the pullback got to our entry point because we would have entered somewhere around here and the pullback got to our entry point. So as a medium-term trader or a short-term trader, you would have just exited your sell trade around the support zone. Or you can also decide to wait for a bullish crossover to happen on the moving averages and then use that for your exit signal. The only thing is that usually, because indicators are lagging, you are not going to get the exit signal immediately when the price begins to reverse. So you will end up giving back to the market some profits, okay? Because if we had used the support level to exit our sell trade, we would have caught more pips compared to someone that exited at the bullish crossover from the MAs, okay? However, it doesn't mean that you cannot use the MAs. You can just decide to use the MAs in case if you are not 100% sure of where a support level or a resistance level is going to be. But in previous videos on this channel, we have talked about some we have talked about some aspects of support and resistance. So you are going to understand better if you check out some previous videos where we covered support and resistance zones. Okay, but just briefly, it's very easy to identify a support zone. All you need to do is to look for a zone or a level where there was multiple rejections, at least 2 rejections. We can see that there was 1 rejection here, and always remember that a support level turns into a resistance after the support has been broken, and a resistance level turns into a support after the resistance has been broken. So in this case, it was formerly a resistance, and then after it was broken, it turned into a support. So we can see that we had 1 rejection here, we had another rejection here, we had another rejection here. So we already had 3 rejections just within this zone, right? So this makes this level a valid support level, right? So once you identify multiple rejections around a particular zone, you can use that to determine a support or resistance level, right? And then you can use that to determine your exit signal, okay? So now in this case, this would have been a good exit signal, and a second exit signal would have been this bullish reversal, okay? Now the other example we're going to be looking at is for the buy trade, okay? Now when you have a bullish crossover, it's a buy signal. So when you enter a buy trade, below the previous swing low would have been a good spot for stop loss, right? And then as for take profit, just like in the case of a sell trade, take profit for a buy trade would have been at the nearest resistance level. The nearest resistance level, remember, resistance level is where we have multiple rejections, right? So if we look back, let's see, we had rejection here, right? We had rejections here. Let's go back forward. Okay, so that coincided with this. We can see. So a short-term trader, after entering this trade, because this was where the bullish crossover happened, we can see the bullish crossover happened here. So we have entered a buy trade here. If we are using resistance zone to determine our exit, then we would have exited around here. But if you are a long-term trader, then you can just decide to trail your stop loss. As the market goes up, you can just trail your stop loss, perhaps some pips away from current price, or you can even use new lows formed to trail your stop loss. For example, when a new low forms, you set your stop loss below the new low. When another low forms, you set your stop loss below the new low, like that, and you keep on riding the trend up until you have a bearish crossover from the moving average. So we can see that using support and resistance zones have their advantages and disadvantages, because in a strongly trending market, or in a strong trending market, if you use your resistance zone or support zone to determine your exit, you might end up leaving a lot of money on the table. Like we can see that the price kept on going up. So if you are using resistance zone to determine your exit, you would have missed out on this large move that happened all the way up to this point. So you would have missed out on that profit. You would have missed out on it. Okay, but in the case of this example, we can see that the support would have enabled you to lock in more profits compared to waiting for this bullish crossover to happen. So it depends on you. Yeah, it depends on the trader to choose whether they want to use the support and resistance levels for their exit, or the crossovers, the opposite crossovers for their exit. So it depends on the trader. Okay, but those are 2 effective exit methods. Those are 2 effective exit methods. Okay, all right. So basically, that is it for this strategy. The strategy is easy to use, very, very easy to use. Okay, now talking about confirmations, you can also decide to use other indicators to confirm your trades, to confirm your entries, to confirm your exits. You know, you can decide to add on indicators, perhaps like the RSI or the stochastics, you know, just to confirm your entries and your exits. Okay, So for example, if you are using the RSI, then your confirmations can be when you have a bullish signal from the EMAs, you can wait for the RSI to cut upwards from the oversold zone. That will be a confirmation. Then for a sell trade, you can wait for the RSI to be pointing downwards. It could either be within the overbought zone or not in the oversold zone. At least it could be between the overbought and the oversold, but it must be pointing downwards. It must be trending downwards, like we can see here. It must be trending downwards. So that would have been a bearish confirmation. Okay. Now, in terms of risk management, it is very important that you apply proper risk management. Make sure that you do not risk more than you can afford to lose. Okay. Make sure that you use good risk to reward ratios. Okay. So, for example, if you are risking $1 in a particular trade, you might want to be targeting at least $2. That will be a risk to reward of 1 to 2. Okay. On the other hand, it's also important that you have a percentage of your account that you want to risk per trade. And usually it is advisable not to risk more than 3% of your account per trade. So in one trade, you should be targeting perhaps between 1 to 3% of your account for your risk. Okay? So if you are risking 2%, then you should be targeting to make 4%. So that's what we call a good risk to reward ratio. Okay? And there you have it, the double EMA crossover strategy explained. If you found this helpful, don't forget to smash that like button and subscribe. We've got plenty more trading insights and strategies coming your way. So stay tuned and let's keep learning together. Drop a comment if you have questions or want to see other trading strategies, and I'll catch you in the next one. Happy trading.